Hello everyone, today I've got three companies I think that are growing rapidly in terms of both their top line revenue and of course their profitable free cash flow. These are high quality businesses that we'll be taking a look at today to see if they're a buy in the month of August. Now, differently from some other YouTubers when they talk about these types of videos, I've actually been buying actively two of these stocks and of course been looking at the other one to add to my £37,000 portfolio I hold on Trading 212. Now, jumping right into it, the first one will come as no real surprise to most people, and if you've seen any of my other videos, you're probably sick of me talking about it, and that is of course Amazon. Now, the full reason why I can't not mention this one for an August stock buying video is, of course, I think both historically and fundamentally it's undervalued right now and offers explosive growth in the future. Additionally, it is my largest position I hold on my portfolio, and over the past week I've added around £700 worth to this one position. Now, I may be getting ahead of myself because with them reporting earnings this week, a lot can happen. But there's many big reasons that I want to share with you guys why I have this company and have such high conviction in it in my portfolio. Now, one of the main reasons is the margin expansion this company is currently seeing. So if we look at their margins, we have their gross, operating and net margins just right here, which shows us how profitable this company is. And we see there isn't actually one of them that isn't improving with time. Now, their gross margin has been improving for years and years consistently, but that's not the one I want to talk about. From March 2023, this company has been seeing rapid improvements in their net and operating margins. And this basically means they are becoming better at converting this staggering amount of revenue that they're able to produce into actual free cash flow and operating cash flow this company can use to actually help investors. So this can be used for any number of ways, including within the company itself, like research and development and acquisitions, which Amazon is quite obviously using it for, or they can maybe start in the future giving back to shareholders by buying back shares, and you may be giving a dividend. Now, why this is an excellent thing to see is because as a shareholder, I want my companies to be as profitable as possible. And that may mean that they return value to me at a later stage in ever increasing amounts. The next reason is the domination of this brand as an e-commerce giant, a cloud service operator, and of course a streaming service with Prime. They're integral to lots of people's lives, and I order so many things from Amazon, and so do all my family members. Now, their brand is one built around efficiency and just widespread availability of products. There are lots of things available on the site itself, and this actually translates to a revenue that's over $590 billion last quarter and still growing in a region rapidly above 10% for such a big company. They have an ecosystem that's actually very sticky for customers. So if you order products on Amazon, you may want them quicker, so you can get the Prime membership to do that. And then of course Prime membership obviously leads you to watch shows on Prime and advertisements that may be on Prime or on the site itself, and so on and so on. Finally, the higher margin sides of the business are rapidly growing as revenue streams for this business. And with that, we are seeing the margin expansion we talked about, and of course, a faster growing operating free cash flow, which actually tends to mirror the share price for Amazon. If it goes up, the share price usually isn't too far behind. And what we are seeing with the likes of AWS, advertisement and third-party seller services is that they are becoming incredibly profitable and growing faster than the main side of the business. If we look at the revenue breakdown for this business, over the years we can see that those aspects of the business were just small back in 2015 and small in terms of the amount of revenue they brought in. But they're quickly growing in terms of how much money they are now bringing in. So this actually helps the top line revenue grow on its own, and of course overall profitability, and that's where we currently see that margin expansion for this company. So bringing it all back, why is it a buy right now? Well, this company usually trades at the moment around the $180 per share mark, and that puts it still only trading around that 19 times price to operating cash flow, which, as we've said, usually mirrors the share price. And historically, over the past 4 years, this has actually sat closer to an average of 26 times. So historically, it's slightly undervalued from that metric. Now, if we take that further and do a DCF of Amazon, saying they will grow their operating cash flow around that 10% for the next 5 years, which actually I believe is pretty conservative. With a slight dilution of shares, which is on track for how they normally operate and not really buying back any. And of course, if we're setting that price to operating cash flow, which is actually lower than the average for Amazon over the past 5 years, if we put it to 24, we get a fair value of $215 per share and a CAGR over a 5-year period around over 13%, which is a market-beating return. And if we change this growth rate just to 12.5% in terms of that operating cash flow per year, we actually get a CAGR close to 16% in terms of share price appreciation. So to me, it's undervalued, and we will have to see what happens with this week's earnings report. The next stock on the August buy list is Mercado Libre, which is another one I've talked about a fair bit in the past. And I actually hold that one in my portfolio in Trading 212 as well. So I've been adding to this position by close to about £400 in the last week or so. Now, I'm not going to go into the massive implications of this business, but this one is excellent for a number of reasons and seems to be undervalued, especially from a free cash flow standpoint at this point. So one of the main things I love about this e-commerce and fintech business is that, just like Amazon, they are having rapid growth, particularly in the part of the business that is highly margined, which in this case is the fintech business. Now, I need to get this name right because I've been told off for it in the past, and that is Mercado Payo. I could be butchering it again, I'm really sorry. But essentially, this aspect of the business, which is the fintech side of the business, is just becoming a bigger source of revenue for Mercado Libre, which, of course, as we mentioned, is highly margined, and that produces greater and greater returns in terms of profitability and free cash flow for this company. Now, they have excellent recognised brands, mainly in Brazil, Mexico, and other Latin American countries, which is trusted to handle cash of local people in that area, especially in areas that are poorer, a bit like Argentina, where there's massive issues with devaluation of the local currency there. And having a brand like theirs handle people's money rather than big named banks in these regions is actually growing very well. And by this graph, we can see that actually the fintech companies like Mercado Payo is actually taking market share away from the big banks quite rapidly over the years. They have a massive growth in revenue to $15.8 billion last quarter and have a CAGR around 58% for growing that in the past 5 years, which is of course very impressive. Now, they do operate in poorer regions of the world, but have a history of profitability, and they of course are embedded in the main areas of their revenue, which is of course Brazil and Mexico. So they are similar to Amazon in how they are used in these countries. And I think their predictable runway for growth is very strong, despite their areas of operation being in the poorer regions of the world. And they've actually demonstrated that profitability throughout the past 3 or so years. So if we talk about the valuation, now historically I would say they look undervalued. They currently trade at a 16 times price to free cash flow, which is so low when they are growing that free cash flow at over 70% in the past 5 years. And now obviously that is extreme growth back from the non-profitability in 2021. But this is not some fluke or a trick. Over the past 3 years they've done this, and rapidly so. And they don't really show any signs of massively slowing down really in this region. And if we look at the 10-year period, we have an average price to free cash flow of over 90. So we have gone from an average of 90 times price to free cash flow for this business to just over 16. And that puts their free cash flow yield at over 6% and the highest it's been in the last 10 years. So there is risk with this company, that's true, but to me they are outweighed by the impressive growth and valuation you are currently getting at buying this share price. So if we do a DCF again with this company and we say that they're growing their free cash flow at around about a 10% again for the next 5 years, and they will trade at a free cash flow price to free cash flow saying around about 20, which is of course above that 16, but again well below the 90 average that we're seeing, both of which are massively conservative for this business if we ask me. And then we get a fair value that sits around $1,870 per share compared to the current share price, which is actually around the $1,600 mark. And that will produce a CAGR of market-beating returns at 12.93% over the next 5 years. Now, I think it's much more likely they will smash this estimate. And that's why I think they are a buy in August, and of course been adding them myself. Finally, we get to the last one for August, which is EVVTY, or Evolution AB. It's a developer and provider and of course licensor of online casino systems for gaming operators all over the world, or a B2B provider. This one is considered a bit of a sin stock, I believe, but it depends who you ask. Now, they're based out of Sweden, and Evolution is a market leader in the online casino gaming space. Now, they offer game providers and gambling sites the likes of B2B solutions. So effectively they offer tables and games that people can play online when they're on these gaming operators. And this has actually been producing amazing returns for them. They've grown almost as fast as Melly in terms of their top line growth at 40% CAGR over the past 5 years, producing 1.9 billion last quarter. Now, identifiable risk, if you ask me, with this company is the legality of online gambling. So it's illegal in certain areas like China and Southeast Asia. And the company itself has been investigated for their involvement with facilitating this through illegal gaming providers. However, they have beat a number of these investigations, and quite recently, because they simply don't really have much interaction with the customer. They don't promote the online material themselves or risk handling it. They just hand that all over to the gaming operator who handles the risk. Now, unlike the other two companies I've talked about, this one actually returns value to shareholders quite materially. So that is through share buybacks and of course fast growing dividend. Now, this is quite recent for this company. However, they have reported buying back around 352,000 shares just last week, which represents around about a 0.16% of all outstanding shares bought back in solely a week. Now, it's important to note with certain companies that are buying back shares that this can have massive returns if the shares are undervalued, which if we're on this channel and we're talking about it, we hope that they are. Additionally, their dividend, on the other hand, is currently offering around a 3% starting yield at this share price and growing above 30% in the last raise. So that's awesome as well. Now, when we get to valuation, and again historically I would say it's undervalued, a bit similar to the other two. They've currently traded at a PE of 17 and a price to free cash flow of the same amount, 17 as well. And that's mainly because they have such good margins. The money that they make from revenue is almost directly translated into free cash flow, which is another benefit to this business. So At a price to free cash flow of 17, it's almost lowest point in the past 10 years. However, if we look at it just on the past 7 years to avoid skewing from this previous metric, we can see that the average has actually sat close to around 38 in the past 7 years. So it's over half the average right now. Now, the company trades at $95 per share right now, which is at the lower end of the 52-week low. And the reason it's down is because they've actually announced a smaller acquisition of Galaxy Gaming, which shareholders weren't really happy about. However, this company has hundreds of licensing that really this Evolution want to get their hand on. So in general, it actually seems a fair acquisition to me. They're trying to break into American markets, and they need to do that through licensing that Galaxy Gaming has. And they don't really seem to be overpaying for it. Now, before we run the DCF model for Evolution, if you've liked this sort of content and want to see more just like it, then feel free to give this video a like and maybe subscribe to the channel. Now let's take a look at the DCF for Evolution. If we say that they'll grow their free cash flow at just 10%, the same as the others for the next 5 years, and then we keep those shares flat, so they're not going to buy back anymore, and they're going to increase the dividend just by 15% instead of that 30% or whatever the last rise was. And then we say that they're going to trade at a price to free cash flow at exactly the same amount that they already are. Then they get a fair value of $108 per share and a CAGR for the next 5 years of 12.89%, which is still a market-beating return. Now, that's obviously massively conservative. So if we play around those numbers a bit more and we change that free cash flow growth to 12%, which is obviously perfectly possible, and a price to free cash flow of around 20, which is probably a bit better and more accurate for this company, and is still well below the average over the past 5 years, which is actually been sitting at around 35 over the next 5 years, then we get a CAGR of around 14.72%. So I think it's very impressive in terms of its valuation and the business model that it provides right now. And it's definitely worth looking into if you can accommodate the risk that this one offers. But thanks for watching, guys. I do appreciate it, and I will catch you in the next one.